Welcome back to the channel. Today we're going to have a good one. How to get so good at shorting the stock market. As we've seen, currently the stock market is not looking great. The companies are crashing. And while for many people the best thing they can do is just to sit out, which I think is a very good option for many traders and investors, other people who are a bit more adept and want to really help their portfolios, they should learn how to short the stock market. Before we get into the video, I want to show you that I am actually a real trader. And when I'm teaching you these things, I actually implement them. A lot of people that I'm watching on YouTube are teaching, they're stock analysts, but they don't actually invest. The fact is that pulling the trigger and investing and deciding that I should buy and short now are very different from talking about the stock market. It's very easy to talk about the stock market, but actually profiting from it is difficult. So here I show you my stock account. And recently I have been shorting a lot of stocks. And it's because I was being stopped out of my long positions and I had to start shorting. I saw the market going down. So you can see a lot of profitable moves. When the open quantity is in brackets, that means that it is a short position. So most of my positions are shorts. I have very few longs, which I've been holding for quite some time, but most of my companies are short. So you see, even my longs, they had bigger profits before, but now the profits have greatly reduced. So before we get into the video, if you like this type of content, I urge you to subscribe to my newsletter, where I'll be keeping you updated for free about the latest stock market trends. I'll be telling you when it's a good time to be in, good time to step out, good time to be investing, what to invest, which companies to invest in, how we find the best companies to invest. I also cater for traders. So you want to sign up for this so that you're always on track, because the fact that shorting the stock market, you have to be on time. You can't do it 2 days after, you can't do it or maybe a day after. You have to be on time to get in for the best feel. So you want to sign up for this newsletter so that I'd be telling you all of these things on time. So we've seen the market is bad and it is crashing. So we should know how to short the stock market. So today we're going to be looking into why shorting is not good for you, why shorting is good for you, the tools you need to short, how to find the greatest stocks to short, and I'll show you some examples. So why is shorting not good for you? The government keeps printing money, so everything is always going against you. The government prints money and is buying up the stock market. It's basically pushing the stock market up most of the time. So you're fighting against the Federal Reserve, which is not a good idea, because probably you don't have more than $1 million, but these guys have trillions being printed. So it's not a good idea to fight against someone with $1 trillion. You got to be on their side. So that is why stocks go up most of the time. So you always want to be bullish. You also may have to pay borrowing fees when you go short. And also when you go short, you're the one in charge of paying dividends to those people who are buying for the company. Because when you're when you're shorting a stock, you're actually borrowing the stock from someone. So that means that when it's time for dividends, you have to give them that dividend. And shorting also has a limited profit. So if I short $1,000, the maximum I can make is $1,000. But normally once you invest $1,000, you could probably make even $100,000. And that's a big gain, but it is possible. So like I told you, watch out for borrowing fees. So you can see in my account, I like to only short stocks where the borrowing fee is zero. Because since you're borrowing it, people might want interest on that borrowed money or the borrowed stock. So here my estimated daily fee is $0. That is good. On to the next step. Why is shorting great for you? Now, when I'm shorting, I'm not thinking about it as a way to really make a lot of money, contrary to what people think. When you're thinking of shorting, that since the stock market goes up most of the time, when you're shorting, what you're really doing is that you're just protecting your account from going down. You're not really trying to make huge gains. It's possible to make huge gains. I'm not saying it's not, but really the goal is really to protect your account from drawing down, so that when the market starts to go up, you have a huge portfolio to make huge gains. So let's say the stock market drops 30%. So other people who had 100,000, they'll drop to 70,000. But you who shorted, let's say you go from 100,000 to maybe just 105,000. So you stay at 100,000 because you shorted and you protected all of your losses on your longs. That means the next time when the stock market goes up 50%, you're going to get way more than those people because your account is now at a higher level. And we can see it right here. There is a table. So on one side, we have a profitable trader and a trader who has uncapped losses. So they both have the same gains, but they have the one with the uncapped losses has bigger losses. So let's think of these as returns from the stock market. So let's say year one, they both get 5%. Great. Year two, the profitable trader knows to sit out or to short the stock market. So he only loses 2% of his capital. This one loses 10%. See, after those strong bearish signals is being wiped out, they both get an 8% gain the next year. Then this one loses 2%, this one loses 15%. So you can see, so over time, while the gains are the same, the profitable trader is going to end up with a 35% gain, while the unprofitable one is going to have a negative 18% loss. This is because that when the market is going down or when their stocks are going down, they've not really protected themselves. So you always want to either put a stop loss and sit out while the market is bad, or you can profit from it by shorting the stock market. The first thing that we have to learn is profit projection in the stock market. One way I like to do it conservatively, because the fact that stocks don't fall so much, they don't fall crazily. They just fall a little bit. So the first one is 3 average true ranges from entry. Like I told you before, I've been shorting the stock market for a while now because it was not looking good. So I already showed you the actual account. Then in TradingView, this is where I actually just keep track of my position. So here you can see all the lines that I'm drawing. Here's my 2R. This one I got in a little bit late, so I'm waiting for it to see if this ETF will fall to 12.6. Cover, I'm longing it. Anything that has a pink thing, that means I'm shorting it. This one I already bought it here around $92. That's why I keep holding it. And while the stock market is crashing, it's not crashing as much. So I'm keeping that holding, and I was not stopped out really. I was uranium, I'm shorting it. I'm almost, getting my profit here. TGB, almost getting my profit. I'm not sure if it's going to reach. I hope it does. I was longing gold, but it looks like I might be stopped out. Silver, I got the inverse ETF. So you can see most of my short positions. Here, some are fresh, some are not so fresh. Some are wildly profitable than others, but you can see I already did it already. So yeah, back to our slides. When you're shorting a stock, you want to have a conservative profit projection. So the first one is 3 average true ranges from entry. That's the first profit projection that I use. I normally cover once the stock reaches 3 average true ranges from my entry, and I use the average true range of the last 14 days. The next profit target that I go for is 4.5 average true ranges, but I rarely go there because I'm a little bit impatient. So I normally just take the 3 average true ranges. So other profit projections that I read from books but I haven't used are you can sell at 20 to 30%. And I realize that most stocks will fall 20 to 30%. So the tools that you need for shorting, you just need to have the 50 simple moving average and then the 20 exponential moving average, which I have here in the picture. You can see the light blue line is a 20 EMA and then the white line is a 50 EMA. Okay, so where do you want to put your stop loss? So for the stop loss, the best stop loss is 1.5 average true ranges above entry. That is the best stop loss that you can use. This picture has an adjusted stop, so it's different from the one I originally used. I normally adjust my stops as I continue, but I think the first stop that I had was right above the 20-day moving average or above the high of that green candle. So those are the 3 options that you can use for your stop loss. You can either use the 20-day moving average, 1.5 average true ranges above the entry, which that one I find is normally a very big gap, so I normally don't use that one. So what I normally use mostly is above the high of the day and above the 20-day exponential moving average. So this is a simple strategy that you need to do to short. It's very simple. You have to wait for the stock to form at least a 4-week consolidation that fails at the 50-day simple moving average. That is the first. Sometimes it's 3 weeks, but I normally don't trust the 2 to 3 weeks. You want to see at least 4 bars on the weekly chart that are consolidating. I'm going to show you an example later on. The second thing that you want to do is after it fails on the 50-day or around the 50-day, then you want to wait for a close just right under the 20-day exponential moving average. And then once that close happens, then you want to sell as soon as the stock crosses under the low of that day where the stock closed under the 20-day moving average. So I will show you examples in my portfolio, which actually I did recently. So maybe let's first do CLFD, which I already showed you there. So it's a very good example. So I always have the weekly chart and I do have, so this is the weekly chart, the 4-day chart, and then I do have the daily chart here. So you see this was a 4-week consolidation. You have to wait. I just wait for like 4 bars. I normally count 1, 2, 3, 4. And now when I wait for a close under the 20-day, this one did not go up to the 50-day. It was more like a flat base. So normally that one is also something you can use. If it takes 4 weeks and it's just going straight and flat, closes under, once it goes below that line, you can short. This one fell 25%. Other good examples are in the portfolio. So let's look at coin, which I actually profited from recently. I'll show you here. I like this one. So we can see that the stock crashed and we can count 4 bars. 1, 2, 3, 4. So fails around the 50-day moving average. I wait for a close right under the 50-day moving average. I was already late. I hesitated that day when it was 204. But then I got in this day at around $196, $197, and then I covered around 164 around there. I'm already out of this stock. We can see here in the profit projection, I have proof. Now, this is my account. I did short at 196 and covered around 164 and then 162. So that was a good trade that happened. So you can see it happening again. So same stuff, nothing new. The first time it failed around the 50 days. So we can see, we can start from this day. 1, 2, 3, 4, fails around here. Wait for the close under the 50-day. Short. This one first fell around 24%. I actually did miss that move, but I just labeled it for you to learn. But then the one which I'm actually in right now is that, okay, now after it failed, I count 1, 2, 3, 4. It fails around the 50-day, closes under the 20-day. As soon as it goes below that day, I shorted it. And that one is on its way to make a profit. TGB, same stuff. Here it failed. We can count 1, 2, 3, 4 weeks. Fails, same stuff. And then here closes under the 20-day, but then you see 2 days. For 2 days it doesn't go below that low. So I actually did wait, and I was late. I was supposed to short, to short it just here around 2.15, but I was late. Sometimes I get distracted during the day, and I shorted around 2.11. I think you can even see that in the account picture in the slides that I was showing you. UGL, that's a long ERX. You can see I did this one correctly. If this was a solo stock, this one was nice. Also, I hesitated. I should have done here 222, but actually did around 220. New, it's also almost done now. This one was a good. You can count your 4 weeks, 1, 2, 3, 4. You can see it consolidating for 4 weeks. Also here, 1, 2, 3, 4. You could have shorted it here for a quick gain. Also this in the same beta. I did the same thing. This one just tracks, beta just tracks Bitcoin. So normally for these ETFs that track Bitcoin, I actually just go to the crypto itself. And you can see I shorted Ethereum using the SETH crypto. So this one is an inverse ETF. So while crypto is going down, this one goes up. And also it's 2 times the movement of crypto. So I knew that crypto was falling. I count my 4-week consolidation, 1, 2, 3, 4. It comes just right above the 20-day moving average. So this is the inverse. So actually, while this one is going up, Ethereum is just doing the opposite. So it's quite interesting. So I did long it here, and then I got my quick gain, but I missed out on extra gains. But that's okay. I normally don't get all of the gains as long as I get my gains and protect that loss like I was showing you. The same thing for Bitcoin. I see it failing at the 50-day after 4 weeks of consolidation, fails at a 50-day moving average that is still sloping down. On the weekly chart, that white line, that yellow line actually means the 50-day moving average. Now it's like the same as this one here. Fails, closes, and I shorted it too. So we can see in the portfolio, that's the stuff that I'm doing. Also, EVAV, I am shorting this one. I didn't put the pink thing, but it is being shorted. So this one, I averaged around there, and it is just waiting to, this one shows electric vehicles. So this is an ETF for electric vehicles. I counted 4 weeks, 1, 2, 3, 4. This is not the best short, so I didn't want that as an example. It's a bit of an advanced play, but that is basically the gist for shorting. Also, the steps is that the stock market weakens. As the stock market weakens, you find a very weak industry. So I saw that crypto was weak. Commodities were weak. So most of my shorts you can see were in commodities. So after you find that weak industry, I'll show you why that is very interesting. So you see, the uranium ETF, it is crashing. And once the uranium ETF is crashing, that means uranium stocks are going to have very similar patterns. So CCJ is one uranium stock. It's pretty much the same. I can even put the uranium ETF here to compare. You can see the movement is pretty much the same. It's consolidate, crashes. New is actually NXE is another. You can see it's very similar to the ETF. I wanted short NXE, but the borrowing rate was a little bit high. But you can see the ETF is pretty much almost tracking this stock. So you see failed at the 50-day crashes, failed at the 50-day crashes, but you always have to wait for that 4-week consolidation. TGB is a copper stock. So if I change this to COPX, which is a copper ETF, you're going to see the same thing. They both go up and they consolidate. They fail here for a quick gain. They do the same thing. But now here's a trick that you have to learn. You don't want to be shorting every time it comes to the 50-day. Only the first 2 pullbacks are to be trusted. So this was the first one and the second one. So the next time it does this, I don't think I'm going to short it, because at that point, the stock is about to start bottoming. So that is a guideline that you must remember. After you find the ETF, then you can look into the stocks themselves, or you can just short the ETF itself. Guidelines: wait for the 50 simple moving average to slop down. If it is slopping up, please don't get in there. There's so many other weak stocks. Why chase the strongest lion that you can pounce on the weak one? Only trust the first 2 pullbacks to the 50-day moving average, like I showed you. Anything more than that, it starts to get suspect, unless the company has been caught for fraud or the business model is actually crashing and the fundamentals are not looking good. There you can keep shorting, but normally for a good, fundamentally strong company, only the first 2 trustworthy, the first 2 pullbacks. And also don't short a lot. Like I told you, just take a small sample of positions and add on them if they work. That is why I was led into some shorting. That's why I was led to short some stocks, because I was waiting to see if the market was actually going to start crashing, and it did start crashing, because at first, last week, I thought it was going long. So here is the URNM ETF, another example, and the ERX ETF that I've already shown you. And of course, there are more advanced tactics for a future video. So we'll talk about late stage failed bases. I learned this from Gil Morales's shorting book. It's called Shorting Disciples. You can look it up. They have really good knowledge in there. I don't have a book of my own. I mostly learn from other people and I come share it with you. Then there are strong failure signals on the RSI and composite indicators. These ones I learned from a woman called Constance Brown. She has a really great technical analysis, and those are advanced tactics, and those are for a later video. So I hope you like this video. I hope you've learned something on how you can protect your portfolio. May the markets be with you. Thank you.